Oh, welcome into a daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, we are chatting just slightly before the Fed statement and the press conference. But you know what? We're not going to focus anything on the short-term moves that could come on the back of this, because I think it's more about the overall trends in the metals. And the recent trend, well, before this week in the little rebound, has been, well, a bit down, has been a reversal for the precious metals, gold, silver, even some of the stocks. What do you think, though? That overall trend, do you think it could last for a little while longer at least?
Yeah, I mean, I think the correction that we've had and perhaps pending consolidation after a correction, this is something, Corey, that I see lasting at least a few months and likely longer than that. And let me explain why. Okay, first of all, if you look at GDX, GDXJ, you look at silver, these markets have all put in bearish reversals on the weekly and even the monthly charts. If you look at the monthly candles and you look at the candles on silver as well as GDX and GDXJ, that's not something that just causes a correction for a month or two. So we're not just dealing with a little correction. And I mentioned with GDX, it rallied up to that 2013, 2016 resistance, which after 2013, it took us 3 years to get back to it. After the 2016 peak, it took us another 3 years. I do, long story short, I do think we're going to be able to break above that sometime next year. But I mean, we're still in September. So it would be perfectly normal if it took a number of months to correct and consolidate after hitting that kind of resistance. And now fundamentally, the Feds today, and of course, as people who obsess over, what are they going to do? What are they going to say? But the fact of the matter is, in recent weeks, Corey, the market has been pricing in tighter policy or less easy policy. I mean, at some point a month ago or so, or 3-4 weeks ago, I believe the market was expecting really like 3 or 4 more rate cuts in the next 12, 15 months or so.
We were even talking about a 50 basis point rate cut. That's way off the table now.
Yeah, correct. And now they're going to cut once. And after that, if you look at the 2-year yield, I mean, that's rallied significantly. So after they cut at the most, the 2-year yield is showing at the absolute most, I think, one more rate cut. But if you look at the percentages and the chances of cuts after this month, you also consider economic data as getting less worse, it's strengthening a little bit. I think there's a 50-50 chance that now the Fed doesn't do any more cuts for the next 6 months, because it doesn't look like they're going to cut in October and maybe not in December. And so then you're basically looking out to almost March. So I think, if that happens, that matches up with the technicals and the conclusion that this is an interim peak that we hit in August, and it's something that's going to last for a number of months. I'm not saying years, but it's going to last for a number of months.
Okay, so what's important there is that you are not seeing this as being another 2016 event. There was a more encouraging move for the metals sector that, we're not going to go through, well, hopefully we're not going to go through another 3-4 years of just sideways to down movement. But the fact of the matter is, everything got a bit so extreme, didn't it? Yields crashed, expectations of Fed easy policy really got to levels that people said that they were going to be cutting every meeting, and even sometimes 2 times cutting the rates as much as they have been. And now, the markets have reversed a little bit, and quite frankly, some of the data in the U.S. has also gotten a bit better. It hasn't fallen off the edge of the cliff, and that's kind of why we're here now, right? The metals got so overbought that a bit of a pullback and a bit of a more come to realization what we have in front of us is needed, and that's what we're seeing in some of the recent moves.
Yeah, that's an excellent point. I mean, if you look at the 2-year yield, I think that got down to about somewhere in the 1.4% range. And, before today, it's been, before the last couple of days, I should say, I think it's kind of been trading around 212, 215. So if you kind of look at that, that's basically factoring in, the Fed is behind the curve by 3 rate cuts. And as I said in my first answer, after they cut today, they're going to be behind the curve by not even a full cut. So the market has the rally in bond yields has tightened policy, and so the expectation is that we're not going to see as many cuts, and that explains. I mean, there's technical considerations also, but that's the fundamental explanation for the correction in precious metals. Now, this stuff changes day to day, so that's not to say that at some point in the future the market could start pricing in a lot more rate cuts. So it's going to be really interesting over the next 3 to 6 months, Corey, what the narrative becomes, because the one scenario is if they have to go back to cuts, even if it happens in middle or early 2020, if they have to go back to cuts, that's going to be really bullish for precious metals. However, if we get inflation kind of increasing and taking off a little bit, I think you've probably seen the core CPI that's at an 11-year high. So if we start to see commodity prices rally a little bit and the core CPI holds firm, and that's more than just the tariffs, you could get inflation starting to force the Fed to hike rates again. But given where the Fed is, given that they want higher inflation, given the pressure from the White House, I think they would definitely let inflation move higher before they even consider doing any hike. So that's another scenario that would be bullish for precious metals. So I'm not, I know this is, it sounds kind of bearish and negative, but I think beyond, once we get into next year, I think most of the scenarios are bullish for precious metals. But where we are here and now, Corey, the market is pricing in tighter policy. And precious metals, of course, got overbought. They made it to long-term multi-year resistance. And it's just natural that when that happens, you're going to get some kind of a correction. So that's the state that we're in right now. Regardless of whatever the Fed says or does, they're not going to change the corrective trend that's ongoing.
Okay, now I think that's a very interesting comment regarding what a lot of people aren't talking about, and that is potentially inflation continuing to move higher. Yes, we just saw recent inflation data that was at 11-year highs, and you know what? That is still encouraging or bullish for the precious metals, but this is also slower moving data. So it's just the bond market can sure swing side to side quite a bit, and inflation data, while it has been picking up, if that does eventually make the Fed slow down on any rate cuts, which you even said, and they have said too, that the Fed's okay with letting inflation run a bit higher, that is still beneficial for precious metals, but that's more of a longer-term outlook, which would take us into 2020. I want your quick comment, though, regarding this little bounce back we have seen in some of the major miners. Some of the comments I've been getting is that just the moves this week have shown, well, an encouraging, almost buy-the-dip mentality for some of the miners. What do you have to say to that argument?
I guess it's encouraging from the standpoint that we do see capital, at least big capital, is still buying the miners. I mean, I don't spend a lot of time watching the senior miners, but as you noted, they have held up a little bit better. But from my perch, Corey, and from where we are, where we focus mostly on the juniors, or I should say entirely on the juniors, what's going on is not encouraging. I mean, you see gold holding up really well. You see the majors have not sold off that much. They're holding up well. But when you look at the juniors, they are weak and they're really struggling. I mean, they've barely rallied in the last couple of days. They're well off the highs that they made in early September or the middle of August. So that combination, when you see gold is the strongest and holding up the best, and the senior miners also holding up well, but everything else is pretty weak, silver included in relative terms. That's not the recipe for a market that's about to end its correction and make a new leg higher. That's a recipe for more correction and consolidation. So, maybe it's encouraging if you work for Newmont or Barrick, or those are the only companies that you own. But outside of that, I would disagree with that statement.
All right, Jordan, let's move on to some of the levels you're watching then. If we assume that this correction is not over, can you share some of the levels that you will be watching for either gold, GDX, or silver? What do you have available for us?
Sure. Well, I think with GDX, the real key level is around 25. I mean, there is a gap there at 24. So I would not be surprised to see GDX now, right as we speak, it's trading just below 28. So, I mean, that's more than another 10% lower if it were to test that 25 level. But yeah, I think it's going to be 24 or 25 for GDX. For GDXJ, probably 34, maybe a tiny bit lower. And I know, again, I know gold has held up well. I think it's holding above 1500 right now. But Corey, if we see GDX and make a leg lower at some point, and it looks like it's going to test 25, that tells me gold at least is going to get down and test 1420 to 1425. I know gold has been holding up well; it's above 1500, but and I know some people were talking about 1475 or 1450. You have to watch the stocks because in most cases they're going to lead the metals and give you an indication of what might happen. So I at some point I'm expecting gold to retest at least 1420. But you know what, Corey? Even if it tests 1400, as long as it has a good bounce and it holds above that, it's perfectly fine for the sector. So it doesn't bother me one bit if gold comes down and tests 1400. I mean, the miners are already telling you that it's probably going to test 1475 at least, and maybe a little bit lower.
Yeah, you know what? Even a test of 1400 is still encouraging for the longer term outlook for the metals, for gold especially, because that is above the breakout level and that is still holding at levels that we hadn't seen since 2013. So I know for a couple months, maybe if it lasts that long, it could be a bit depressing for precious metals investors, but hey, if you've been in some of the majors or even just played that breakout in gold, you've made some pretty good money just in the last about 4 to 5 months. So no market goes straight up. I know we've said that many times, but it just seems like time and time again, the metals investors want that market to go straight up. And with some of the recent data and especially some of those moves in that bond market is telling us we could be in for just a little bit of a slowdown and natural correction. Jordan, great chatting with you. Always enjoy hearing what your technicals are showing, and I always find it interesting how it also lines up with some of these news events that are expected and sometimes come out of left field. Jordan, great chatting with you. Everyone, click that link below. Go visit Jordan's website, thedailygold.com.